Hey guys, Greg Silverman here. Hope you can see me as well as hear me. Join me for, this is Come Learn With Me. Okay, this is an interesting article. It got some good reception. It comes from Mark Cuban's blog and was actually initially published in February 4th, 2016. It's a long time ago, but don't tune out just yet. There's a reason everyone liked it, and there's a reason why it was recently published. So let's just go through it and see if we can't learn something new. The precognitive antitrust violation, how the decimation of the IP market has hurt the economy and worse. Okay. In 1995, that's what he wants to discuss. Okay, in 95 we started. Sometimes it's useful to read past articles, just by the way. You can glean what was said and what became of it. In 1995 we started Broadcast.com as AudioNet. In July of 1998, we took the company public. Within a year, 330 employees were worth more than $1 million in Broadcast.com stock. We became one of almost 300 companies to go public that year. We were one of about 125 to go public with under 50 million in sales, and became one of the 8,000 public companies listed on the major exchanges. So you remember this is the Internet 1.0 boom. The amount of destruction in the IPO and public market since then and its impacts on the country are what can only be described as horrific. Let's go back in time and look at the entrepreneurial thought process. I remember my goals and those of my peers very well. Build a great company, grow it as big and as profitable as you could, with the ultimate goal of not only generating profits, but also taking the company public. Entrepreneur's thought process. Let's see if we can taking the economy back. Okay. So entrepreneurial thought process back then was taking the company public. Yeah, that was the dream. Why take it public? Because the stock market was a source of cash that could help you grow. It was a marketing and validation opportunity that told customers and prospects you had arrived. It was a liquidity opportunity that, while not guaranteed, if you could continue to grow the company over the long haul, would value your company at a multiple of earnings and allow me, my investors, many who were close friends, and my employees to increase our net worth and cash holdings. The capital from the public markets could also allow us to retain our independence. As a public company, that sounds like a mistake. Going public doesn't allow you to maintain independence. As a public company, we not only had our IPO cash, we could go back to the markets for additional offerings. Keep moving forward towards our corporate goals, and the possibilities were only dependent on our ability to execute our plans. Being public, unlike the private markets, where every cash raise is a battle over valuation, we know exactly how the market was valuing our company. So, a few points worth noting. With our public cash, being public, being public versus private. As a private company, the best I could do was take cash out of the business as a reward. That's not a bad thing. It had worked well in my first company, Micro Solutions. Wasn't Micro Solutions recently in the news? The guy Saylor, I don't know if it was Micro Solutions, but Saylor put the whole balance sheet into Bitcoin. We never had a losing month, and I was able to generate a lot of cash. But anything I took out was not there to grow the business. Maybe I took too much out, but we never were quite big enough to go public. Our liquidity event that rewarded me, my partner, and our employee came in the form of a sales CompuServe. Even though it worked out well, had I been able to take Micro Solutions public, I would have. So would have every other entrepreneur I knew. We all wanted to go public. That was how you had a chance to get obscene amounts of wealth. Back then, the goal wasn't to be a billionaire. The term was simply fuck you money, which was however much money it took to own a private plane and not to have to work again if you chose not to. For all but a few built huge private enterprises, the goal was only attainable by going public. Anything noteworthy there? Was or is that the level of greed good? In my word, those same peers would reward their investors and employees just as I did. So yes, it was. Just as hundreds of my employees attained 7- and 8-figure net worth, we were not unique. The same happened at many of those hundreds of companies that were going public every year that were able to execute their business plans. More importantly, it was a source of drive, was motivation, not just for me, but of all our investors and employees. We all could see what happened when the companies we knew went public. We got to talk to their employees and hear the stories of the amazing wealth they'd earned. For those of us who wanted to achieve high-level financial success, it made us work even harder. Fast forward about 16 or 17 years, it has all changed. All right, I think we're missing point here. So, okay, that's why you want to go public. Not get the obscenity. Okay, fast forward. It doesn't matter how or why I've written enough about SEC, no reason to rehash the ineptitude here again. What matters is that today's entrepreneurs do not see taking the companies that they've built public as a reasonable, even smart goal. Instead, they want to stay private as long as they possibly can. They want to raise series A, B, C, D, E, until when, I'm not sure. The reasons are not many. They don't want the reporting requirements, which have got more onerous and expensive since we went public. Even accounting for the new Reg A plus offerings. Reg A offerings are like crowdfunding offerings or smaller offerings, 50 or 20 million. They don't want to deal with the regulators. I can appreciate this one. They hide behind the straw man of not wanting to have to play the game of meeting quarterly expectations and hyping the stock to investors, neither of which is a requirement of going public. In contrast, ask any entrepreneur these days how much of their time is spent wondering how they're going to raise their next round. Personally, I think they're wrong, but it's their company, their decision. Unfortunately, the momentum of stay private movement is devastating our economy. Here is how. That's interesting. And this is back in 2016. Hundreds of $billions from investors from mom and pop to huge funds are tied up in private companies and returning nothing. The capital is dead money. It doesn't matter what it is marked on their books. It's dead. It cannot be reinvested anywhere. That hurts the economy. So, okay, no liquidity. We're not talking about dead money for a few weeks or months. We're talking years, okay? Maybe just years, maybe a decade or more. Okay. I'll give him that. The balance sheet of The balance sheets of probably 80% of those investors massively overstated because those private companies can't or won't go public. That creates its own potential issues because of the uncertain liquidity of those hundreds of billions of dollars. The remaining liquid assets of those investors placed far more conservatively. Okay. Not only is the money dead to investors, it's dead to employees of those private companies. Sure, some of the hottest companies that found raising their fourth or fifth round easy may return some to key employees, but those companies total how many? 10 out of how many? Tens of thousands of private companies that have raised capital. And even when it's only upper management, the rest of the poor people working for those companies are most likely to stay that way, poor. Okay, let's just see how long that is before we stay that way, poor. Okay, where are we? The dead money tied up in stock owned by anyone not in top management is one key reason that income inequality continues to get worse. Let's do some guessing with math. The dead money, yeah, I mean, it's possible. It's not cycling around. Let's say that like in 1998, 300 operating companies went public, and let's make a guess that each one of those 300 companies had 200 employees that had vested stock options. So there's 60,000 employees with stock in a newly public company. If the average value of the stock at IPO was 25,000, that is 1.5 billion increase in liquid net worth to everyday Americans in a single year. If the majority of those companies continue to grow, then the value accrued to paid by the hour and salaried admins, analysts, security guards, receptions, etc., will enable them to participate in the same wealth creation that the 1% does. That is of no small importance. As a point of reference, here is an article that says that more than half of America has a net worth of less than 25,000. Yeah. So by working for a company that goes public, you immediately increase your chances of having a net worth greater than half the country. To me, that is a big deal. Replicate the wealth impact each year, and you can do far more for the net worth of hardworking Americans than any government policy or tax change. Nothing else can add thousands of people a year to the rolls of the top 50%ers like a revitalized IPO market. So let me just understand. So he's saying that because I guess if people would be able to, if it was IPO, they'd be able to sell and get the liquidity for their stocks. But it's kind of locked as employees. Okay. When private companies can't or won't go public, they become easy pickings for their competitors by them. In my not so humble opinion, this is the ultimate productivity investment killer in the USA today. There's a lot of financial engineering, right? Oh, yeah. One of the reasons today 3,700 public companies hoard cash is because they know that rather than investing in uncertain R&D and productivity enhancements to protect them against the innovator's dilemma, Upstart companies that could disrupt them and their industries, they can simply buy those companies. They recognize that the current conventional wisdom for those disruptors is to stay private, which means that with just a minuscule number of exceptions, the investors will be prying for them to be acquired. Why would a company invest in the uncertainty of R&D and other innovative organic options when there are hundreds of billions of dollars of dead money tied up in groundbreaking companies, all looking for liquidity? In this age of stay private, it makes no sense to build when you can buy. That's a great observation. When you buy, you not only have far greater value certainty versus R&D, but you also eliminate a competitor, and you may get the additional benefit of paying for the entire investment through job cuts. Oh, yikes. Okay. Sounds very pseudo-capitalism. It is undeniably destructive to our economy and future that many of our most innovative and exciting companies are bought by their competition. It is a pre-cognitive antitrust violation. I know that sounds laughable in so many ways, but at its heart, it's true. It's also incredibly destructive to our standing in the world and our economy. Some say that this is all wrong because there isn't a free market for IPOs. There will never be a world where 300 companies go public. They will point to January of 2016, which had no IPOs, as proof of just how impossible an IPO market revitalization will be. I will tell you that the lack of IPOs is more a reflection of the intent of today's entrepreneurs. The market is dying for growth companies. There are so few growth stories that companies with $250 billion market caps are looked at as growth companies. If entrepreneurs made going public a goal again and had their IPOs while they were in an accelerated growth period rather than 10 years into their business cycle, and only when the investors demanded it, I know I would be all over buying their IPOs, and so would other investors. If you have gotten this far into my long-winded diatribe, thanks, Mark. Thank you. Let me be clear, I'm not religious about any of this. I believe it. I'm investing and trying to fix it. But like everything else, I'm putting it out in public in order to check my whole card and get feedback from everyone so I can get a little bit smart about the whole thing. Thanks, M. So be sure to check the article out. There's 63 comments. Let's jump on one. You lost me at income inequality, but grabbed my attention with the explanation. Thought-provoking, I admit it. That stated, it's hard to imagine someone like this would turn around the perceived problem. Okay. Well, we know companies are staying private for longer. That's because they're accessing cash. And yes, it might cause an income inequality, but these people who are earning hourly and salaried wages would need to, access the capital markets through 401k retirement plans, or other retirement plans. So anyway, interesting observation from a very successful entrepreneur. Thanks for joining me. I hope you learned something.